Okay, hi Art. This is Ed Butowsky. I'm with ChapwoodFinance.com, and I'm really happy to be joined today by Art Nunes. Art is the Chief Investment Officer at a group called Northwest Asset Management. And Art, what I really like about what you guys do is that you have 5 different portfolios that you manage. You're the Chief Investment Officer for them, and you manage this money for registered investment advisors as well, directly with high net worth, or even just, even if you don't have a lot of money, individuals. Did I get that right?
Yeah, that's exactly right. There's my team and I consists of 4 people. We call ourselves a Dynamic Investing Group, and we're all advisors within Northwest Asset Management, and we do run those 5 models for high net worth as well as a sub-advisory basis for other advisors.
I got you. And just to kind of put things in perspective, ChapwoodFinance.com is a search engine and a portal to help people become more knowledgeable, not only investment advisors but also individuals, about how to do a better job with their money. So with that in mind, Art, right at this very moment, where do you see the challenges and what are your fears in the market, and what are you doing in your portfolios to compensate for that?
Great question, Ed. We find ourselves for the last 13 years in what we call a secular bear market for stocks. It's been more or less a sideways trading pattern. Everything we make in the shorter term up cycles have been given back in the short term down cycles. And we also find ourselves with negative real interest rates that the Federal Reserve has generated for us, penalizing investors and savers. So the challenge for investors is that the last 12, 13 years, these kind of market conditions have flipped the risk-return continuum, in that we were all taught the more risk we take, we should be rewarded with a higher return. It's just been the opposite. The more risk we take in the last 13 years, the lower return we've gotten. And I think investors have put a crutch on investing in the bond market to lower their risk the last 13 years, and it's worked. However, that might be ending here because the next major move in interest rates, in light of the unsustainable amounts of debt and creation of new money around the world, is probably going to be significantly higher at some point. So looking to bonds as a crutch to lower their returns may not be there anymore. They may actually increase their risk by putting money in bonds in the years ahead.
It's funny, Art, because one of the things that I'm noticing with people is that a lot of investment advisors are showing what returns were over a period of time, showing their historical returns. And if 50% of that money was in the bond market, you can pretty much toss those returns out going forward, because there's not a chance in the world, it's actually mathematically impossible to replicate the returns over the last 10 years in the bond market that we saw in the previous 10 years.
Exactly, and that's a great point, because most of these asset allocation models based on modern portfolio theory require input from the people running the model, and they're using, like the last 30, 40 years, one of the best secular bull markets in bonds in history, and as we just said, that's ending now.
So what specifically are you doing right now? Let's just take a hypothetical portfolio. I'm catching you on the spot here, but this will show everyone how smart you are. Let's say we had a portfolio, we had 50% in domestic equities, 25% in developed international markets, and 25% in emerging markets. Someone came to you with that portfolio. What would you do at Dynamic Investor Group to really reduce the risk in that portfolio?
Okay, well, we believe that all portfolios should consist of 3 parts. A fixed income component and what we call a growth equity component, which are longer term equity investments, and then an alternative investing component. All 3 components should have a behavior so that they have a low correlation of performance with one another. Because I don't know what's going to happen in the future or when it's going to happen, nor do you or anybody else. But what we found in the last 31 years is that by putting these 3 components together, they really do complement each other very well in all kind of market environments. So I would first look at the portfolio and see where the gaps were. Do they have an alternative component, a growth equity component, and a fixed income component, and then go from there.
What do you like better, gold, silver, or platinum?
The commodity trends in the near term right now are down. And in fact, gold and silver just recently broke some pretty good levels of support here. And if that follows through in the days ahead, there could be some significant downside risk, which is actually pretty surprising to me in light of the fact of how the global central banks are inflating the world's currencies. So We don't like commodities right now as a general investment in the near term.
Okay, and then when we look at the bond market, a lot of people misunderstand the difference between high yield bonds and interest rate sensitive bonds. High yield bonds really move based on the balance sheet of the corporation. Would you dive into those at all at this point? Here we are, February 21st, 2013.
Well, we've gotten really good profits in high yield bonds in our fixed income model. It represents 10 to 20% of the portfolio. Right now it's 10%. I won't say we're nervous, but we're very cautious because the spreads between high yield bonds and investment grade are historical low points. So as that spread widens, that means the price of high yield bonds is going to go down. So we are cautiously still investing in high yield bonds, and how we do it is through a high yield bond ETFs.
Okay, so you implement most of your portfolios with exchange traded funds, which I will tell you I do as well. Are there any individual stocks, and I'm not going to say that you're recommending one versus the other, but do you implement portfolios with individual stocks, and why would you versus an ETF? It's probably a better way of asking that question.
Okay, great. Yeah, one of our models is called Global Income Stocks, and it consists of 20 to 25 dividend-paying stocks, and it can be all cap, small, mid, large, domestic, international. The stocks are selected for consistency of paying dividends historically and increasing those dividends historically, and finally, the growth prospects are that they're going to get dividend increases going forward. One of the best areas to invest in the income stock market the last few years, and we think is still a good place to be, are the master limited partnerships, MLPs. And although there's some individual ones that we've owned, Capano Energy was the last one, but they just got bought out. So we own 2 ETFs in that area. The ticker symbols are AMJ and KYN, the Kane Anderson, and the Alerian MLP ETFs.
I understand. I like those as well. I love the way that you implement the portfolios, and I think more people out there need to really look at the ETF portfolios and actually hiring groups like yours. I mean, this isn't an advertisement. I wanted to interview you because I think you do a great job, but at the same time, I think more people need to manage their money very similar to how you do it. So keep up the good work, Art.
Thank you, Ed. Have a good weekend.